Hello, everyone. Welcome to the final bar. We're going to talk about this market pushing onward to the downside, the direction of this market's movement. Hopefully not a surprise if you've been watching the show. We've been talking about these patterns of distribution, these signals that the markets are in a period of deterioration. Days like yesterday, giving a false sense of security to a lot of investors. Today, back to reality with gaps lower and some of the big box retailers pushing the S&P further to the downside. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny and beautiful Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the technical toolkit. I'm often asked how I can be smiling and happy on market days like today. You know, I learned a long time ago, don't let your mood be dictated by the markets. That is tough to actually live by, and maybe I'm numb and or scarred from previous market pullbacks. But if you've not lived through some of these bear market phases before, days like today can be pretty chilling. And don't get me wrong, I'm not thrilled by the direction of the movement in the markets, but I've certainly learned to put things in a proper perspective. That's why we talk a lot about the big picture movements, right? Are we making higher highs and higher lows? Because individual days can have different movements. Remember that just by coming off, 4 or 5% today, we're still not to a new low for the year, right? We're sort of relative to where it's all about where we are now and what we do today relative to where we've been. Days like today, though, I would argue certainly illustrate the underlying trend to the market, which remains to the downside. And we have great guests on the show. We had some technical issues with Mark Chaikin, our guest today, so we'll see if we can get him on. But it might be a revisit to Mark's discussion, hopefully very soon on the show. Tomorrow we have another good guest for you, Louis Llanes, joining us from Colorado. Louis is a financial advisor, uses a very technical quantitative methodology to his process, so it should be a lot of fun. John Kosar, by the way, from Asbury Research, is going to be on the show next week on Tuesday. Let's continue on today's show. Let's try to unpack the movements in these markets using the technical toolkit. As I was mentioning in an interview earlier today, charts, I think, are always a good thing to pay attention to because I think they tell you as much as they can, or I think they're probably the best equipped to help you understand the underlying movements in the market, but especially at times like these, where the markets are uncertain, where you have an increase in volatility, we have plenty of uncertainty. Define your process using charts and defining lines in the sand. Identify your potential return and certainly focus on your potential risk to avoid getting caught up on the wrong side of days like today. The S&P down 4% today, really pushing lower through the course of the day. Gap down at the open, just really never looked back. There was, at times you have sort of that initial sell-off and then buyers coming in. There was none of that. It was just a pretty consistent pattern of distribution. The NASDAQ bounced around a little bit going into the last hour, but at the end of the day, down almost 5% to 11,420 or so on the NASDAQ composite. Mid caps and small caps both down as well. The small caps index down the least, which was still down over 3%. The VIX, which was down in the mid upper 20s as of yesterday, spiking back above 31. And again, if you talk to me about volatility, we talk about the VIX. I'll share with you the chart of the VIX and how I feel like we're in a higher volatility regime. I would not be surprised if the VIX continues to be in the 30s, if not even further, given potential for further deterioration in stocks. Bonds actually following through as a bit of a safe haven today with the TLT up over 2%. Interest rates coming off a bit. And I think while the longer term trend of higher rates is certainly one of the big themes to be thinking about in 2022 and certainly continue to think about as the Fed talks about their plans through the course of the year. When things really get squirrely, when people sort of take their foot off the accelerator of risk assets like equities stomp on the brakes, the question then is, where do you go, right? Where do you put your capital? And it's in cash or cash-like items. It could be in gold. It could be in some, something that has a sense of stability and inflation protection. Bonds certainly being a bit of a safe haven today, up a bit, over 2%. The dollar index using the UUP up about 0.5% as well. Commodities overall coming off. Now, one of the interesting, conundrums of this market is that while the markets overall are pushing lower, while the speculative technology stocks have already sold off significantly over the course of the last 6 months, the larger tech and consumer names, things like the FANG stocks, now breaking down in recent weeks and months, certainly continuing. You still have these outliers, things like energy and others that are holding up and pushing to the upside. I would start to be, looking for signs of capitulation when those things start to roll over. It's not really happening yet, right? Things like Oxy and DVN are not far off of their all-time highs. I'll be looking to see if those start to come off as well. Cryptocurrencies pushing back to the downside. You had a nice bounce higher with Bitcoin regaining 30,000 as we were shooting the show yesterday, right back down below that key level. And again, if you're looking for signs of optimism, cryptocurrencies have essentially been a proxy for speculation, right? And I think what you've seen with major coins and also some of the less common coins, you're seeing a lot of flights to a crowded exit, right? A lot of people trying to get out of positions. Bitcoin down about 4% today, Ether down about 6%. Let's look at a chart of the S&P 500. We'll start with this daily chart of the S&P 500 to show where today fits into the big picture. I might show another chart or two just to try to make sense of things. When we're looking at a daily chart of the S&P, just the difference from 2021 to 2022, such a clear, a rotation, right? From uptrend to downtrend, right? From accumulation phase to distribution phase. And the weakness that we're seeing today, while the severity of it could surprise you if you were looking to buy on the dips, the direction, the overall move, hopefully should not be surprising. If you've been watching the show, we've been talking about this for quite some time. Elliott wave analysis, of which I am not a huge fan. I mean, I don't use it a ton in my process. And I'm not a big believer in some of the pieces of it. What I absolutely love are the behavioral aspects. I love thinking about who is doing the buying and selling, what sort of, movements that you see in the markets and this wave-like patterns, which absolutely are the case. One of the great takeaways, I think, is this idea of impulse move and corrective moves, right? So if the overarching trend is positive in 2021, which it certainly was, you have the impulse moves, which are a move in the direction of the larger trend. And then you have the corrective wave, right? You have a brief pullback that is a counter trend move. So even though the uptrend is still in place, you get these pullbacks, and that's how you can buy on the dips. In a downtrend phase, which I would argue we're now in, it flips over. So the impulse moves are down. The corrective waves, sort of the counter trend bounces, are back to the upside. This is where you need to mentally switch as an investor from buying on the dips to selling the rallies, right? Waiting for the price to move higher and selling that short-term strength. That's where you are able to short or get out of positions in a position of relative strength and plot for the next things down. That's when this rally of the last couple of days tells me to be looking for some sort of rollover. What's interesting, if you look at what has now happened given today's down move, is you had a rally over the last week that didn't even get us to the intraday low from February. So now all of a sudden, this chart starts to look a little more like we broke down through 4,100 in mid-May. We've now retested that level from below and are failing at this point. So long story short, the S&P would need to regain those February lows, regain that 4,100 level, regain the swing high from yesterday. If and when that happens, I think this market starts to look a lot more constructive. At this point, you're just looking for a higher low, some sign of stability, some sign of accumulation, some sign that willing buyers are coming in and buying on the weakness in price. I'm not seeing that yet today, and that's what I might be looking for if I were you. One other chart I just wanted to show, I was sharing this with my market misbehavior premium members earlier today. Just wanted to bring this up. When you're thinking about what happens next. And again, this sort of environment is not something to be afraid of. It's something to be analyzed and understood. And hopefully, if you're a newer investor, this experience that you're going through now should help inform you the next time. 10 years from now, you'll find a similar pattern and you will remember this rotation 2021 to 2022. That's what, talking with people like Mark Chaikin, you get that sort of that sort of a thought process. Walter Deemer, who ran the technical research department in Putnam Investments, I was talking to him about the 1974 low, the 1982 low, the 1983 breakout when the Dow gets above 1,000. These are the lessons you pick up as an investor. That's why experience in this business, I would argue, certainly matters, because you have the battle wounds to show those learning experiences. The tuition you pay to the market is another way to think of it. So what happens if this downtrend continues? Well, we're getting very close, and I think we're within a rounding error of a very widely followed potential area of support. 3,800 is about a 38.2% retracement from March 2020 to January 2022. That's why we've been talking about that level for a number of months now. Others in the industry, some of my peers, are also keying in on that level, because it's sometimes there's a lot of just clarity in terms of where particular levels may line up. I think that's why you'll see that 3,800 or 3,820, if 15, something like that, level will be quoted a number of times. That also represents a 61.8% retracement from the September 20 low to the January 2022 high. So there's some symmetry there, indicating that may be a potential area of support. So two things I would suggest. Number one, I'd be looking for a support there to see if that actually plays out. My more concerning outlook would be, what if that level fails? What if we all expect support at 3,800? What if we get a little bit of a bounce, but then that's it, and all of a sudden things start to rotate lower? That's the danger for this market, and that's something I would be concerned about as you're following some of those key levels. Just to finish off our market recap here with the time we have left, utilities, the best performing sector, still down 0.9%. So again, on a relative basis in this sort of sell-off, you'll find the defensive stuff will be working better than anything else. Utilities is the outlier in terms of not going down a ton. The consumer sectors are what absolutely killed it today, with the XLY, the XLP, both down over 6%. A lot of that is earnings driven, but certainly indicating some weakness underneath the hood in these markets. We need to take a quick commercial break. We'll be back with my next segment, ETFs Engage. We'll see you in a minute.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the activity in these financial markets. Thanks for being with us every weekday, particularly on days like today. We're here to help you unpack what happened and put days like today into proper perspective. We have a couple more segments to break down some ETF activity and some relative strength movements. But first, just a reminder, part of the show during the week are the Final Bar mailbags. We did one on yesterday's show, had a lot of fun answering some of your questions. We'll do it again at the end of this week on Friday's show. You can send your questions to us three ways: via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. We are so fortunate to have just a fantastic group of experts and guest opinions and analysis coming through StockCharts TV on any trading day. All of it is available for free on demand at StockChartsTV.com, or on your mobile device. Just search for StockCharts TV on demand. Our next segment is called ETFs Engage. What we'd like to do with some regularity is look at the ETF space. ETFs are interesting because a lot of people, I think very rightly so, think of ETFs as equities, right? In a lot of ways, they have very similar behaviors. They trade like equities. They have the liquidity that equities do. So you can think of it the same way. Now, there are other parts of ETFs that are obviously very important: how they're structured, how they're managed, the fees, the spreads. All of those, I hope, are part of your due diligence process before you would take a shot at an ETF, or particularly an exchange-traded note, an ETN or a trust or something that's kind of like an ETF. If it's not exactly an exchange-traded fund, it's a different structure that you definitely want to be familiar with. But I've learned just with ETFs that are very equity-like, there can be some interesting things to look at. Now, part of my dashboard that I look at here on StockCharts.com are the scooter reports. I often have this going through some different universes. I usually look at the largest US stocks. As you can see, if you're familiar with some of these tickers, it's mostly energy companies at the top of the scooter rankings. This is our StockCharts technical ranking. It's a proprietary ranking system based on traditional trend following momentum toolkit. It has a couple different time frames. And if you want to learn more about it, just go to the Chart School link at the top and search for SCTR, scooter rankings. You will find more information on the methodology. But if you look at ETFs, we have a group of ETFs. I forget how many in there, 150-ish. I want to say, but I might be making that up. I'll have to. I need to have a better answer for that. But I think it's about 150, 200 ETFs, if I remember right. And basically, what we do is do that same percentile ranking system from the strongest positive trend to the strongest downtrend, and we percentile ranking them from 0.1 to 99.9. As I was looking through this list, I saw that the top 5 ETFs were basically one of two things. I'm looking at BERZ, which is basically a short FANGs ETF, SARK and SOGU, which are basically ETFs that do the inverse of the ARK Innovation Fund, ARKK. And then you have 2 energy ETFs, UNL and UNG, which are basically ETFs that are designed to mirror the price of natural gas prices and unleaded gas prices. So what I wanted to do is just talk about these ETFs. Number one, so we made the decision a while ago to include some of these inverse ETFs in our scooter ranking. So certainly be familiar with that and recognize that when an ETF pops up, it might actually be an inverse ETF. So BERZ is the first one we'll look at. It was released back in August of 2021. And if you know, like the inverse of this would be like FNGS, the FANG plus ETN, or really like the Qs are probably a pretty good proxy for this. So this is more of a direct comparison. So if FNGS is long the FANGs, BERZ would be short the FANG stocks. And the reason why I think this is interesting is one of the issues that you will have as you look at a bunch of charts, if you are not on guard for one of the classic behavioral biases, is you will fall victim to what's called the endowment bias or the endowment effect. Here's what the endowment effect means. Let's say you bought the FANG stocks, or you bought the FNGS, and you owned it back here, right? When the FANG stocks are just doing incredibly well, outperforming in 2020, kind of market performing here for a lot of 2021, and then started to roll over. What happens is you feel really good about your purchase as it's doing well and as it's gaining value. As it starts to roll over, instead of recognizing that change of trend, instead of recognizing the fact that it actually topped out in November and now it's just making lower lows, you dig in your heels, right? You sort of convince yourself that this is still a good position, and your brain will do all sorts of things to protect your ego from having to admit a mistake, from having to admit that it's no longer a good position. That's called the endowment effect, where you have this sort of emotional attachment to a stock that you own. And as a result, you don't take the action that you should because of that emotional connection. Now, how many signals on the chart of the FNGS should have told us that things were changing from an uptrend to a downtrend, right? Instead of being above 2 upward sloping moving averages, all of a sudden it's below 2 downward sloping moving averages. Instead of bouncing off of the 200-day moving average, as it did many times, it traded below the 200-day moving average and has remained below it. It went from making higher highs and higher lows to lower lows and lower highs, right? All of those signals, breaking support, et cetera, all indicated that there was a change in character. So how do you prevent that? Number one, recognize, right? Be aware of it and make sure that not just that you have a thorough process of technical analysis, but that you actually do what the chart is telling you. Draw a line in the sand and take action, set an alert and actually do something when the alert is triggered on a stock or an ETF that you own. That's number one. But another trick we would used to do is invert the scale. So if you put the minus sign before any of the tickers on StockCharts.com, it will actually just invert the scale. So instead of plotting it from zero to infinity going up, zero's at the top and it's going down. So you basically have just flipped over the data series. So what we would often see is if this is a stock that you're struggling with, if FNGS and you're not sure whether or not you should still hold it, no problem. Invert it and decide, is this a stock that you would want to own? And given what I'm seeing, right, all of a sudden it seems pretty clear when you turn it over. It's gone from lower lows to higher lows. It's gone from lower highs to higher highs. This would be a great stock to own, right? I mean, if you're just looking at the chart, you're kind of rotating to the uptrend. It's breaking out. It's a nice move. So if this would be a great long idea, why would you not be shorting or out of the regular version that's actually going down? Now, what's cool about some of these inverse ETFs is you don't have to just trick your brain and invert the scale. You can actually look at a short ETF, right? An ETF that has short exposure to that. So that's why BERZ, if that's an attractive chart to you right now and you see the potential for upside there, why would you own FANGs if that's the case, right? If the ARK Innovation Fund is looking like this, what is the short ARK, SARK? What does SOGU, which are two of the top 5 ranked stocks? If those are charts that look good, why would you want to own the ARK Innovation Fund, which is essentially the inverse of that? So with this segment, ETFs Engage, what we want to do is just talk a little bit about the relationship between a particular set of ETFs and the short versions of that. You can do the same exercise with some of the leveraged versions, but in particular, inverting the scale of a chart can help you to disconnect from an emotional attachment to a particular ticker. Looking at the inverse versions of some of the ETFs you might be looking at can also bring some clarity to your process as well. Let's continue on with our next segment. It's all relative. This is where we focus on relative strength. And I feel like I am on a lifelong, professionally, I'm on a lifelong process or a lifelong goal, a vendetta, if you will, to encourage individual investors and financial advisors to focus on relative strength. If you look at the charts that Grayson Rose or his father Gaddis Rose, Gaddis, an exceptionally successful investor and great educator, has taught so many individual investors how to make sense of things using charts. It's a focus on relative strength. It's a focus on what's working and what's not working based on relative inputs. How is this stock or this sector or this ETF performing relative to all the other levers you can pull? The reason why I wanted to focus on this today is because I'm struck on my dashboard. If you look here, this is the market movers widget. This is showing me the S&P 500, and it's showing me in order of the stocks in the S&P that are up or down. Now, the screen is not broken. This is reality that only 5 of the 500 members of the S&P actually finished in the green today. So the fact that the object itself is not full size because there weren't 10 stocks that actually closed higher is pretty rare, and it tells you the overwhelming down move that you saw on one particular trading day, today's trading day. So two things I would tell you. Number one, look at what's working on a day when everything is not, right? Look at what's different. Look at what's actually holding up when the average stock is not. Now, there's TJX, TJ Maxx, you have AIZ, NRG, PGR, Progressive, and EA. Let's look at just a couple of these to see what's happening. Now, the challenge with something like TJX. TJX is a nice bump this week on a week when I feel like the main story with earnings has been disaster, right? With Target, with Walmart, both gapping lower in a pretty big way. I feel like those are the headlines. But if you look, there have been some names which have had some decent bounces, right? Home Depot bounced yesterday. The problem is it's right back at the lows for the year today, right? So the positive earnings release, not enough to fuel any sustained rally. That should be a warning sign in terms of if you're bullish on these markets. In a bullish environment, companies that beat earnings, companies with optimism and with improving prospects down the road, according to what they're telling us, should be awarded with higher prices. That's not necessarily happening. We're seeing a similar move today with TJX gapping higher, but failing to close above the 50-day moving average, closing below the open. This might be an interesting chart to watch to see if it continues lower tomorrow. And I had a nice hammer candle, by the way, yesterday, which is why I think it's an important one to watch. So tough to really call that a sustained stretch of outperformance. That's more of a one-day sort of bounce. AIZ is maybe an example of a better fit for the it's all relative segment here. If you ask me to identify what are the types of stocks that have shown strong relative strength so far this year or in the last couple months, Three things immediately that come to mind. Number one, energy, obviously, and we'll talk about DVN, maybe Oxy, some of those other ones that have been in just these nice, consistent uptrends, certainly seem to be continuing that process. The second would be insurance companies. Now, not financials, broadly speaking, which have really been struggling for short charts, like BlackRock, making new swing lows again this week. But a chart like AIZ is actually holding up pretty well. If you look at the relative strength, which is at the bottom, this is the relative performance of AIZ versus the S&P 500 going into year end. Pretty negative downturn, right? The 6 previous months had been a deterioration in relative strength as the price of the stock was going lower, and the S&P and NASDAQ were making new highs going into year end. But look at what happened into the new year. Well, the S&P peaked out in January and has rolled over. AIZ actually bottomed out in January and now has rotated higher. That's a great sign, an example of a stock that went from underperforming to outperforming. These are the types of names in any environment you probably feel pretty good about owning because it's in an uptrend, pulling back to a tactical 50-day moving average, rotating back to the upside. Not a bad chart, actually, and potentially doing a bit of a bull flag pattern. We get above 190. I think that completes a potential move to the upside. The second bucket I mentioned would be the energy stocks, things like DVN and Oxy. Now, both of those names pulling back today, along with everything else, not as much as the S&P, but pretty decent pullback. But if you look, it's the relative strength that's what's so compelling, right? For over a year now, just this nice consistent run of relative strength. Nice consistent uptrend in price. This may be the high, right? Today and yesterday may be the eventual high for DVN. I don't know that. But what I do know is I have never been disappointed by owning charts in consistent uptrends. At some point, the trend will be over. Then you can get out of that and move on to something else. But at this point, decent trends that overall have been holding up pretty well. The third option, by the way, if you ask me, utilities, right? Overall, utilities have not been as attractive on a stock by stock basis, but you can't deny the relative strength over the last 6 months. So the point of it's all relative, focus on relative strength. Look for stocks and ETFs where the relative strength line is improving. That will help you to navigate this sort of choppy, uncertain environment and help you outperform in difficult times. We need to wrap this show, folks, and go to the 3 and 3. Let's go through 3 charts in 3 minutes to tell this story of the market. We'll start with the S&P 500. We're actually using the spiders. So I wanted to play just a little bit on volume. If you look at this bounce higher that we saw in the week up until today, I can't help but notice that the volume trend has been steadily declining. Today on the sell-off, you get a bit of an increase in volume for sure, but the on-balance volume close to making a new low again for the last 12 months. A bear market phase is usually marked by stocks making lower lows. In general, you tend to have lighter volume on the rallies because the market's rallying, but you have less buying power. It's not a bunch of buyers coming in. It's more short covering. It's more buying on the dips, but not really sustainable accumulation. So the fact that you had volume accelerating to the downside in late April, in May so far, the volume has actually been lightening up as you rotate to this little bounce, now re-accelerating with heavier volume to the downside. That's more characteristic of a down market. On balance, volume making a new low for the year certainly does not tell you you're in a constructive market environment. Chart number 2 is looking at breadth by cap tiers. Now, this is a breadth indicator. It's not quite updated for today's close. Some of the closing prints are starting to come in, and we're updating our databases. But this is looking at the New York Stock Exchange, large caps, mid caps, small caps. You can see that 3 of these are color-coded bright red, and that they have, in the last week or two in May, basically have made a new low for the year. Given the deterioration you saw today, most likely we see all of those 80 lines at the very least turn downwards a little bit. I would be looking in particular to see the S&P's advanced decline line undercut its low from March. It's the only one of those 4 AD lines that has not made a new swing low yet. That might be something to look for to see if we can confirm a new leg down in the S&P 500, potentially en route to 3,800, if not further. Finally, charts like Take-Two, TTWO are good charts. Nice bounces at the very least, right? Tactically speaking, nice bounce. What concerns me on a chart like this is the bounce sustainable? If everyone goes risk off, charts like this start to fail, I'd be looking right at the high for today at 125. That was the swing high from late April, early May. Can it get above that and hold it? Otherwise, be watching a retest potentially of the previous lows. That is our show for today. I want to thank you all so much for joining us every weekday after the close for the final bar. All of our previous interviews at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.